Today's episode is brought to you by Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's STREAMRG.com using the promo code MicroCap. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you're listening to episode 203. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@SNNWired.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. A special thank you to our sponsors for today's episode, Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's STREAMRG.com using the promo code MicroCap. And to Quarter, whose mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. Visit your app store of choice to try it out, and that's QUARTR Quarter. We are now 1 week away from the SNN.Network Canada virtual event that's happening December 7th through 9th, 2021. Please go to Canada.SNN.Network to see the full list of issuers, speakers, sponsors, panels that will be joining us. Paul Andriola, on behalf of Small Cap Discoveries, and myself, on behalf of SNN Network, are teaming up to highlight our neighbors to the north, Canada. Paul and his team have been finding value accretive opportunities on the TSX, TSX Venture, CSE, and now the NEO. So we wanted to host an event that encapsulates all of that. So you can expect 3 days of keynotes, educational panels, company presentations, and one-on-one meetings. To register, please go to Canada.SNN.Network and click the register button. We look forward to seeing you all there. Speaking of the SNN Network Canada virtual event, for episode 203 of the Planet MicroCap Podcast, I spoke with Harold Leishman, the senior investment advisor at Canaccord Genuity Wealth Management. He will be moderating a panel at the event showcasing 3 companies that he discovered using the Leishman Methodology, a working title, which is the topic for today's conversation. I wanted to dig a little deeper into the algorithm Harold and his team put together, backtested, and they continuously use to uncover, monitor, and lead to more qualitative follow-up with management teams. I really enjoyed our conversation, and I highly recommend you sign up for the conference, again, at Canada.SNN.Network to hear this panel as well. Thank you again for tuning in to episode 203 of the Planet MicroCap Podcast, and please enjoy my conversation with Harold Leishman. This episode is brought to you by Stream by Mosaic. You can find them at www.streamrg.com. That's STREAMRG.com. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream was built by Mosaic, and unlike any other transcript libraries, Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.com. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And I'm really excited to introduce our next guest here on the podcast. He's actually going to be moderating a panel at our upcoming SNN Network Canada virtual event happening next week, December 7th through 9th, 2021. The panel is titled, well, we have a tentative title. Offline, Harold was just giving me a hard time about what it should be called. He was embarrassed that we had it up there originally as the Leishman Method. It wants to be called the Leishman process. I don't know the difference. You all are out there smarter than probably tell me. But having said that, let me introduce my guest here first. All right. So joining me right now is Harold Leishman. He is the Senior Investment Advisor at Canaccord Genuity Wealth Management. Harold, great to have you on, man. How you doing?
I'm doing great. Thanks, Robert. And thanks for having me. I really appreciate it. And it was just the Leishman Method. It's more just like, it's not have a title. It's just our process is what we do to try to find interesting ideas. But it's your show. You can call it whatever you want.
I'm trying to help you with some branding, okay? Like the Leishman Method process. Just some numbers I threw together to pop out some interesting things. I don't know. I'm trying to help you here.
We can use help on the marketing side. Anyway, thank you so much for having me, and I look forward to your event next week. It'll be a lot of fun.
That'll be a lot of fun for sure. By the way, for anybody who wants to go and register, I should have probably said this in the open too. Go to Canada.SNN.Network so you can see Harold's panel. It's really great. I'm very excited for you all to see that. But let's dig in a little bit. I mean, today's interview, obviously I want to get to know you quite a bit better, as well as also really dive even deeper into the Leishman Method / process. Actually, maybe that will be just the name of it, just method / process, just to really mess with people. But Harold, as we always do on this podcast, I always like to start off with, where did your passion for investing come from? We spoke offline before, so I love your family history here. So dig in.
Yeah, so I'm a third generation Canadian venture capitalist. My grandfather got started in the venture capital business. He was a surgeon in Saskatchewan in the 50s. And, he and some friends wanted to have a bit of a side gig. There'd been a ton of oil discovered in Alberta, and they were starting to make some discoveries in Saskatchewan. So they decided that it'd be fun or interesting to list and build a little oil and gas exploration company in Saskatchewan. So they listed what would be the equivalent today of a CPC, like a Canadian or a capital pool company. There might have been 4 or 5 million shares outstanding. Then they went and found themselves a geologist, and the geologist said, "Okay, well, we'll bid on some of these land auctions that the government's putting out." And so he said, "Here's my number 1 pick. If we get this, it's going to be golden. Number 2 pick, not quite as good, but we're very excited about it. And if we don't get either of those 2, we've got a 3rd pick that will at least get us in the game, and we can kind of build the company from there." So the land auction comes up. They don't get their 1st pick. They don't get their 2nd pick, but they are successful. They get their 3rd pick. However, they've used all their money to make the land acquisition, so no money for drilling. And then they go and need to find a joint venture partner, which they do go find a partner. And they go in, drill a couple of wells. They hit an absolute gusher, blow the lid off of the oil rig kind of discovery, a Beverly Hillbillies kind of oil discovery. It actually turned out to be one of the largest discoveries at the time in Saskatchewan history. It was the Steelman Field. And their end of the production was about 1,600 barrels a day at a little over $2 a barrel. So that's a little over $1.5 million a year of revenue, which, today doesn't sound so big, but in 1955 or 6, it was actually quite a bit of cash flow. They weren't a professional management team, so there was a discussion that they should sell the asset. They had a cash bid for the company. My grandfather was more interested in building a business than selling the business, and he went and found a secondary bid from a small upstart mining company that was interested in using the cash flow from the oil and gas revenue to build out their gold mining assets. So the company that was coming in was a company called Tech Hughes. It was run by a guy called Norman Keevil. My grandfather's company was called Canadian Devonian Petroleum. They ended up buying Canadian Devonian, and they sort of smashed it all together, and they renamed it Teck. Now, Teck today is Canada's largest diversified mining company. My grandfather sat on the board until the day he passed away. And they were tremendously successful. And I like the story, A, because it's a family story, but B, if you think about it, their first two choices they didn't get. Their third choice was when they got the people who got the first two bids drilled the properties and there was nothing. So there's a fair bit of luck involved, and obviously having cash flow to build a much larger company is kind of an interesting concept as well. So that's how my family got in the business, and that's why I'm here.
Very good. I mean, so from that inspiration, so you always knew you were going to be in some way, shape, or form in finance, investing,
I didn't actually. I had no idea. I got a degree from a university on the East Coast. I very shrewdly got a degree in English and philosophy, and found myself basically unemployable. It was through a family connection that I got a job in a fish retailing operation as an assistant manager. And, there was enough money to pay for the rent, but there wasn't enough money to buy beer. And so that wasn't a very happy experience. And then, on the weekends, I'd get in my car to go somewhere and everything would just smell like fish. So, it wasn't a great situation. My father had been on the institutional side in Toronto before I moved out to Vancouver. So I reached out to him and said, hey, give me some names and numbers of people that I can go, I'll do anything. I just need a job that has some upside and doesn't make me smell like fish. I'll get coffee, I'll stuff envelopes. And he had been looking for an assistant. So he said, why don't you come work with me? And having no other real prospects, I, reluctantly agreed to come work with my father, which actually turned out to be a great experience. We worked together for about 18 years. So that's how I made my way into the business.
Very good. Was there some sadness that you didn't get into the mining and metals industry at all, or?
We did a lot of, listen, for the bulk of those 18 years, we financed a lot of mining companies, a lot of oil and gas companies. So we did do that. Some greenfield development, some brownfield development, some rank startup businesses. We always had higher highs and higher lows, but the swings were large. They were big.
Very good. All right. So then catch us up to today. You went to work with your father for 18 years. Now you're the senior investment advisor at Canaccord Genuity Wealth Management. Catch us up from, to where you're at today.
Yeah, well, it was a very small business when I joined with my dad, and I was young and hungry, so I would always go to shows and meet people like you and all that sort of thing. And so we grew the business nicely. And at one point, we made an investment in a small company. It had some revenue before, and things hadn't gone well. And it was basically at death's door. And we bought a significant chunk of stock in that business, and they ramped revenue from basically zero to about 18 million. In about 18 to 24 months, and they were putting cash to the bottom line. And at that point, sort of the light went on. Like, what else can I find that's like this? I should say, incidentally, that management team turned out to be terrible and then promptly drove it into the ground. But I was intrigued by, finding companies that had revenue and cash flow as a more stable way to speculate. And then I had the good fortune, I went to an LD Micro conference in California. I was introduced to Paul Andreola. This is before he started writing his newsletter, and he very generously sort of shared with me, his investing criteria. And, from there, I just kind of started digging in. I mean, you start chipping away at little bits of information. So I was manually plotting company financials as they came out and seeing how it kind of affected the share price. Then I went back and I looked at stocks that had huge returns based on growing revenues and earnings, and kind of dialed in on that 4 to 6 quarters before the company really took off, to see if there was some sort of common thread I could find to try to find these things sooner, and get a position for myself and my clients. And I kind of got it down to a number of common denominators of things that made sense. From there, we went and ran a whole bunch of back tests to see, like, if you invested in companies with this type of criteria over 10 or 15 years, what kind of returns would you get, to try to narrow down what the best criteria were for me.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter. And that's Quartr. Now back to the show. Got it. So now we're starting to dig in a little bit to the Leishman method / process / algorithm. So,
right.
All right. As I said at the top here, we're having this panel at our event talking where you're going to be kind of going through that on a little bit shorter scale, because that's only going to be 45 minutes. And then you're going to have a few companies that have popped up on there, so let's dig in. You started to get into a little bit more. So tell us a little bit more about the Leishman method / process / algorithm and how it all works.
I definitely need a shorter name than that, but it was, well, basically what we found was, if you're looking at small companies, and we excluded resources, I'd had my fill of resources over the years, and I understood the cyclicality. So we took those out. They've got no pricing control over their product. So we're looking for small companies, under 150 million market cap, under 150 million shares outstanding. So you can try to get, good torque per share if there's good, good revenue or earnings growth. We wanted high margin businesses, greater than 20%. We put in, we wanted to have, for the back test, EBITDA, at least EBITDA positive. So making a little bit of money. I will say I'm not hell bent on that. I'm more interested in EBITDA momentum. So you can be losing some money, but as long as the trend is towards making money, then that's interesting. And if you plug that into like a Canadian screen, all of those criteria, you're going to come up with only 80 to 100 names. So from there, the algorithm, what we did is that, okay, we want to buy the 40 names that are cheapest on an enterprise value to sales basis or a price to sales basis. And then of that subset, you would buy the 20 companies with the fastest revenue growth. So you're sort of looking at companies that are generally inexpensive on that price to sales metric, and then picking up the companies that are growing the fastest. And, the back test, and I will say back tests are they're only an indication. You can't actually recreate them in real life. It just lets you know if you're fishing in the right pond. But in this case, the back test, it crushed the major indices. And what I was most excited about was that it did it with sort of very little correlation to the overall market. And it kind of makes sense if you think about it, right? It's not rocket science. If you've got a small company that is relatively inexpensive and growing fast and making lots of money, it will go up independent of whatever the general market is doing. So that was sort of the math that we settled on. For me, the hard part came to, how do you manage this much data? I was no longer inputting stuff by hand, right? It's hard. So if you're following, 80 companies, what is that? That's 320 financial releases a year, plus acquisitions, dispositions, private placements, management changes, daily share price fluctuation. How do you manage all of that data and kind of keep focused on that core group that you want to focus on? And I will say, I am actually really proud of the data set that we've produced. I don't think there's anybody else in the Canadian retail environment that is able to share this kind of data set with their clients. There's institutions and family offices that have resources that might have that, but I haven't seen any other broker maintain a data set like this. We basically will keep, a running 3-year history of companies' quarterly revenues and trailing 12-month revenues, the growth rates of each, and then every sort of measure of profitability that you can think of, from gross margin to EBITDA margin, pre-tax income, as well as a snapshot of their capital structure over that period, so you can kind of get a feel for how are they financing their growth? Is it just pure raw organic growth, or is it are they diluting the heck out of themselves or taking on a bunch of debt to grow? And then everything's tied into a live quote system. So from there, we can rank that universe, that 80 to 100 company universe, and you can measure by whatever criteria you want. Is it which companies have had the best quarterly growth recently, or trailing 12-month growth, or you can say I'll give a point if they're EBITDA positive, a point if their quarterly growth is in the top quartile, a point if their trailing 12-month is in the top quartile, and then a point if their valuation is in the cheapest quartile, right? And that's kind of what you're looking for. Like I said, it's all sort of tied to, real-time quotes. We've hired a full-time associate who's 2/3 of the way through his CFA to manage the database and help us, crush all the data that comes out in the financials. And that's our methodology, by whatever name you want to call it.
Very good. All right. Well, let's dig a little bit deeper into it. So first thing that maybe some folks might be asking themselves, including myself, even though, look, it's fairly obvious because you are Canadian, but right. Why just Canada? Other than being Canadian, and that's not the main reason. I think there's a couple of features, and I've heard it before, I think, on some of your podcasts. Number one, for small companies, the quality of the financial disclosure in Canada is fantastic. It's all audited. So you're getting really good quality financial information, which for me is sort of paramount. And it's a reasonably effective venture capital system. It's as effective and efficient as any bureaucratic situation can be, which is not, it's not great, but it's probably better than most. And then on top of that, it's very small and tends to be illiquid. So if you imagine you've got these sort of existing businesses that are making money or not making money, whatever the case may be, and then behind that, there's these massive waves of liquidity that come in and go out, whether it's a mining market or an oil and gas market or a cannabis market, and these huge rushes of liquidity come in will drive valuations of everything higher. And then when that bubble pops, the liquidity comes out and everything goes down in value. But the underlying businesses are still doing their thing, right? They're still growing at whatever the rate is. They're still making money because they're not tied to the fluctuations in the market. And that illiquidity or that inefficiency provides fantastic opportunities for investors that are following the numbers to buy some positions in some great companies with great prospects that are making money. Got it. All right. So then let's talk about the ranking system then a little bit, because I think that'll be very indicative of some of my questions after that in terms of like sizing into positions, doing some of the qualitative stuff. So can you tell us a little bit more about, I mean, you showed me, I think it was like a couple of weeks ago, the full spreadsheet and like how you have it ranked. But for those obviously who didn't have access to that like I did, can you explain how that works?
Well, so for me, the ranking, the most important thing, well, not the most important thing, the thing that drives share price movement for me, or from my perspective of it, is revenue growth. How is the company growing faster? And so if you can try to find things that are growing the fastest, you could do quite well in the market, especially if you can try to buy them at a fair price. I'm not so much of a deep value guy. There are some positions I hold that are deep value, but they take great patience. Returns is time and percentage improvement. So I like to be a little more timely, looking for things that are going up now. So as I said, we will rank the data in a number of different ways. Specifically, we'll look for companies that have outperformed on a quarterly basis. So they may have only had one quarter, they're up 40% over the same quarter last year. You should dig into that to understand what's driving that and is that repeatable. That's sort of the first clue that something interesting might be happening. So that's one way. Obviously, trailing 12-month revenue growth is another. EBITDA growth is another. And as I said, we have a series of other, algorithms, giving a point system, right? So if you're one of the cheapest companies on that price to sales basis, but you're one of the best in terms of quarterly revenue growth and trailing 12-month revenue growth, and you're a high margin business, that EBITDA expansion is going to be significant, and the company will get re-rated, hopefully, to a much higher level. When I was doing some of the backtracking work, I looked at one company as an example where, they were growing at about 50% on a trailing 12-month basis. It was a high gross margin business. I think it was around 48 or 47%. And they had gone from, losing $800,000 a year to making $800,000 a year in over 4 quarters. It was trading for 1x sales, give or take, and about 6x earnings. They then put on another 4 quarters of 50 to 70% revenue growth. We were able to do a financing at that initial price. 12 months later, the institutions came in and they financed it for, I think it was 7.5x sales and 65x earnings. And the reason for them is there's only so many growth opportunities where they can put money. And at that point, I would argue that's probably a little expensive for what I'm trying to find. So did I answer your question, or am I just rambling off?
No, you did. No, you did.
Okay.
Well, the thing that you're making it very clear, and I think this ties back to your at the beginning when you said, you're a 3rd generation venture capitalist. For me, the main reason that you're saying that is because a lot of the names that you're looking at, if they weren't public, they'd probably be that venture capital stage potentially, some of them, not all of them, but the thing that's really great about the TSX markets, or just the Canadian public markets, that I've come to really appreciate is that it's a really great ecosystem for companies to go public a little earlier in their life cycles. And I think that's where you kind of step in, is for folks that have that venture capital background. It's like, well, great. Like I can use what I've learned when I go and study these private, growthy type names, and I can now apply that to public markets. And it's even easier because, hey, I got access to all this, great information that sometimes you don't get access to. Most of the time you do, but because they're public, they have to be,
right.
There can't be any kind of fraudulent weirdness, right? Because
right.
Yeah, they have to disclose, right? So, on that note, I mean, what's really amazing about, being able to apply this method and having this methodology for, kind of VC level-ish, this level of public companies, in the small micro nano cap space, you get to also do some of the qualitative side. So when you see some of the companies show up on your list, I think you said 80 to 100 names, maintaining the database, making sure it's all up to date. Part of that includes having to go and talk with management teams and get some more information. So what are the types of questions and what are those meetings like with management teams, after you have a company that shows up on your list?
Yeah, I mean, it's pretty straightforward. We do try to reach out to most of the management teams after every quarterly report. Oftentimes there's not necessarily a lot to discuss. The numbers can be fairly straightforward, but the more you talk to management teams, the more you kind of get to know their style. Are they overly promotional? Do they overpromise and underdeliver? Or are they always sandbagging? What the results are going to be, and that way, when you're reading the news releases, you kind of get a better feel for what to expect. It gives you a chance to better understand, maybe what their vision is. How do they plan to exit? How do they take it from being a small business to a big business? Is it going to be, via acquisition? Or are they going to funnel a ton of money into marketing? The small cap space fundamentally is a bet on the jockey. So the better you can get to know the jockey, the better your overall situation, I think, should be. Ultimately, you hope the good jockey produces the good numbers. So getting to know them is sort of key. On the qualitative side, it allows us to dig a bit more maybe into, the quality of the revenues. Obviously recurring revenue has got greater value than, non-recurring revenue, but there's variability within that, right? It's not all black and white. So there's all kinds of stuff to learn and take away.
Well, what's interesting, the reason I ask is because I feel like, between you, Paul, Dave Barr, some of the best out there, Jacqueline Rishi, between you folks, you guys are more or less playing, well, maybe not so much Jack, I think she's a little bit on the larger side, but you guys are more or less playing in a similar sandbox when you're at looking at the company subset, right? It's a small community of non-resource, non-cannabis, more or less microcaps that are revenue generating at a minimum, maybe 4 quarters away from profitability, break even, or grow, whatever it is, so the main reason I wanted to know is about how you talk with management is because I feel like that's also a key differentiator between maybe some of the questions you ask versus what Paul asked versus what Dave asked, versus what maybe Matthew Martin over at Revlon asked,
Sure.
So for you, when you look at that list, and you're then creating your ranking system also based on some of the conversations you have. What are some of the things where, if you hear management say this, despite what you might be seeing in the numbers, are you like, that might be cause for maybe backtrack, and or on the other side of things, maybe this is something that I should be looking into a little further?
Yeah, I think that's a challenging question. I'm now sort of rolling through all the different conversations I've had.
Don't worry, that's why I made sure to ask it long. So
give me time to think. And I would argue it's very generous of you to lump me in with Paul Andreola and Dave Barr and Matthew Martin over at Revlon. And we do, we do end up crossing paths with those guys a lot. We end up. It's like, hey, I'm in this deal, and hey, so are you. Or I remember one time I was buying a large block of stock in a company that was trading for, a very low multiple of earnings, and I had it kind of mostly placed. And then I called Paul and said, hey, by the way, I got 100,000 shares left for this block we're going to buy if you want it. And there was silence on the other end of the line. And he's like, well, I can't buy it because we're actually writing it up the next day. I was like, oh, that's fantastic. Good for me. So anyway, but what kind of questions do we ask? It's really, I find if you see a problem in the financials, we had a situation recently where, the company had got itself over levered, and when you ask a question and they don't give you a decent response, you need to ask that question 6 more times, but maybe from a different angle. I don't necessarily know how Paul asks his questions or Dave Barr. I think Dave Barr looks at things more of a private equity side. We're just trying to get down to the truth of what's driving the growth. Can that growth continue for the foreseeable future? The next 2-3 quarters. Do they have capital needs? Because obviously, as a broker, we like that if we can buy a big chunk in a financing, or if you've got some debt, if we can convert your debt to equity, that's kind of a line of questioning we like. That's a tough question. It really kind of depends. It depends on the company. We're looking for how does this thing stop growing? How do they get sideswiped by something that you can't see on their website or that's in the financials? But I would say, most of our focus is on the growth side. Can they maintain the growth or profitability?
I mean, another reason why I wanted to ask is because, we're putting this out before the event. There's going to be a number of investors listening to this that might be doing one-on-ones with some of these companies that might actually be on your list, right. So, I mean, if going into some of these one-on-ones, because look, you probably get access to more management meetings than most, right? We
try to have a lot.
Yeah. You try to have a lot, right? What would you say is that one burning question that you do? It's just a requirement that you have to ask every single time, to each management team, so that will at least steer the conversation, or maybe give you some kind of indication of, okay, I know where this is going, or okay, I know where this is going.
Yeah, that is a challenge. I wouldn't say it's a burning question. The one dumb question we ask at the end of every interview is what should have we asked? You tell, we've asked you a bunch of questions, what didn't we ask about that we should have asked about? And sometimes you get a response, and sometimes no, you kind of covered it off. For the most part, these small companies, their financials aren't that complicated. So if there's, I was reading some financials today, and revenue's gone flat, and their SG&A is up 25%. So, there's gonna be some questions. There's gonna be some questions around that. I already talked to management, so I already know. Look, we're building. We're positioning for growth. So to take it to the next level, we need more staff or more bodies, or frankly, there's a labor shortage going on right now. And we need to pay people more to come to work, because I don't know if it's like in the US right now, but in Canada, they just give money to people to not work. So you need to up your game. So, for us, all our questions are primarily around financials. So it really depends on the company. What are your management dreams? Say, Robert, you're 55, you've been at this for 10 years, you've got the business really going. What are you going to work till you're 95? What's your exit plan here? How do you exit stage left? Are you going to sell the business? Or are you just going to work until you keel over at your desk? Or what's your game plan there? And that's always an interesting question, I guess.
I like that question.
Because
it's a good question.
Well, people like small businesses because it's fun, but you also have to have an exit, and maybe do it again, right? Lack of insider ownership, stock's down. How come you're not buying stock? There's all kinds of questions you can ask.
Right.
And I wish I was better prepared for this question. I think these
are some really good examples.
you just have to sit and listen and get a feel for the management team. Are they honest? Are they credible? Do they have a greater vision? So
let's get. So my next question then is, after you've done all your due diligence, you see companies, they showed up on the list. You've done your qualitative. All right, now we're talking about sizing. Let's say, all right, they ticked all the boxes. I'm ready to open a position. What does that position sizing look like? Do you start small, let execute, size in? How does it work?
Yeah, I guess there's a couple of answers to that question. Personally, I'm a big believer in a diversified portfolio. I like to have lots of irons in the fire, and believe in the subset doing well over time. A small, fast-growing company. So, the number of times you look at something and think this is it, like I'm going to go overweight this. It rarely works out. So you're better to be diversified. And because it's not just me, I'm dealing for clients, we'll go and see if we can get a block to kind of, everyone gets a little position, kind of see how the stock goes. And there's variability within that as well. If the company's financing, you'll take a bigger position if you have more comfort because the warrants are always nice. One of the things that we try to do within our model is also kind of see, how is the stock acting in the context of the venture market? I talked before that, when there's a big market running, you get these huge waves of liquidity that kind of drives everything up. I think, and I don't know the math, so I'm kind of pulling this number out of the air. I think the venture exchange goes down about 70% of the time. And so, if you can find a stock that is acting independently, you might want to get more aggressive. If the stock is starting to break out and it's cheap and it's making money and it's going fast, you may have to be more aggressive and say, let's get our full position now. Either we'll hunt around, look for blocks. You call the management team, any blocks for sale. Are there options that are coming due? Are there warrants coming due? Or you can kind of get some size in a block trade. If the company has, research coverage already by one of the other firms, you can call their desk and say, hey, we want 500,000, 1 million shares to get started. And maybe they know someone, right? So you kind of have to fish around to get that sizing. If it's just kind of going sideways and the business is growing, well, then maybe you just sort of take a small block, or maybe you just start chipping away for a few clients and build a position over time. The illiquidity makes it a challenge as a broker at that time. We have a couple of family offices we deal for, and they just look at it and say, they view this as semi-private equity. Getting in, getting out is really difficult, but you've got a long-term, look at it. You're a little bit less price sensitive, because you're looking 5 years down the road. So, again, I wish there was a hard black and white answer, but I also think if you're too rigid on anything, you end up missing opportunities or making mistakes. You've got to be somewhat flexible in your approach.
Hey man, if there was a hard black and white answer, I don't know if I'd have a podcast. Okay, so I'm glad there's a bit of a nuance, and it's not just we do it like that.
That's right.
That would not be. There's no one would that. That wouldn't be as entertaining. Come on now.
So it's but you sort of work your way into position, and like I said, I like 20 odd companies, 25 companies. Whatever as a position. So, maybe you start with a 1.5 or a 2% weighting, kind of get a feel for it, maybe see how the market reacts to future news releases. Like today, half day in the US market's down, almost 1,000 points. There's usually opportunities to, buy up something at a better price that you just can't see coming. So,
dude, you should do this. You should put this algorithm in for U.S. equities. I'd be fascinated to see what comes up.
Do you know what? We can have another sort of off-air discussion. I have a partner, and he does the conservative wealth management side of the business. Canaccord Genuity acquired a firm in the UK years ago, and they have a world-class quant system that covers every security in the world. It doesn't do the small companies so well, but you can see some of these small companies, like these small microcaps, show up every once in a while, and that's always interesting because you can kind of see that it's picking up on showing up on some institutional radar screens. But I'll walk you through it. It's spectacular. It's kind of a combination of an ultimate what works on Wall Street, 5 value criteria, 5 quality earnings criteria, 5 momentum criteria. You can add whatever other factors you want, but it's a combination of that and a fairly advanced discounted cash flow modeling system that sort of interprets where things could go. It's fun to play with.
That's really cool. But, and listen, what's really interesting about, the Leishman methodology, that actually, I think might be it, is, it's interesting, whether it works or not, I'm not here to make a call on that. But the reason that it exists is because within Canada, there's a lot of noise, right? I mean, folks might be listening and think like, really, there's a lot of noise. I'm like, well, yeah. I mean, look, it's primarily dominated by junior mining industry, cannabis, now psychedelics has taken hold a little bit.
Right.
And that's no comment on any of those sectors whatsoever. It's just they're more heavily weighted in those sectors. So when you have some of these, industrials for the most, because now I'm getting into some of the sectors of the companies that are listed in your methodology. A lot of them are tech, industrials, some consumer. It's really interesting to see that it's a lot. It just so happens it's a lot of these, non-heavily weighted companies that usually make up the venture, the TSX, CSE, especially the CSE. And now the NEO, so it's interesting that you almost need to have a methodology like this in order to sift through some of the noise in sectors that, folks may not be interested in.
Yeah, no, absolutely. I would even argue, we had a discussion in the office today, because we will go in and, we find a company that's growing and we'll go and sort of disaggregate the revenue streams within it. But then you have to say if you look back over the last 3 years, you can see different segments doing different things. But 95% of the revenues in USD, they're reporting in Canadian dollars. You got to go back and sort of plug in those exchange rates because there's 20% swings in the exchange rate, which even makes the financial reporting, that much more complex. Or I shouldn't say reporting, but it makes the analyzing the growth rates a little more complex. You can overinflate growth to on one side, and it can totally high growth on the other. So it's it's never boring.
That's for sure. How do you backtest it also for for the March 2020s or the the TSX? This year had quite a roller coaster to say the least.
Yeah. So I haven't done any backtesting in a while. Frankly, I've been just sort of focused on the data sets and improving the data sets and adding more features that we can use. But you go through, you put in a 15-year backtest. It included 2008, right? So that was, there was an event. So, the process certainly had negative returns in that environment. And in those extreme environments, correlation always goes to 1. When things really go to pieces, and I'm remembering your advice that, this is a family-friendly show, so no swearing, but when things really go to pieces, correlations go to 1 and everything goes down. But, these businesses, that doesn't mean the business disappears. Quite often the business, they maybe have a setback. I will say with COVID, as an example, COVID blew holes in all kinds of financials. Depending on what sector you were in, suddenly your revenue's been cut in half. So that's, that was a big wrench in the works for me, for sure. And so now we're looking at, okay, well, you can't just say, well, Q3 this year is up over Q3 last year. Last year was a COVID quarter. You've got to look at what was Q3, the year before, Q2 the year before, or whatever it is. And are you making, new high watermarks, or is it just you're recovering from sort of a COVID depression? So it's, you have to sift and sort the data a bunch of different ways and think about it and then kind of take your best assessment. It is never cut and dried.
Absolutely. All right. Well, I think we covered did I miss anything in covering the methodology that you wanted to discuss, or do you think we covered it?
I think we've covered it. Look, if people want to see it in action, we don't have any secrets. We're happy to sort of demonstrate it to people. like I said, it's not rocket science. It's just a lot of work. So
a lot of work to say the least. But between you, Paul, Dave, and Matthew, and all the other folks that cover non-resource Canadian microcaps, I tip my cap, man. You guys more so than anybody I know read every filing, do a ton of work on these names.
Yeah.
So that's listen, and I would hope folks listening really, through osmosis, maybe, take in some of that, because it's, you put in, you'll get out what you put in, right?
Yeah.
Yeah,
absolutely. And it's amazing with cash flow, what opportunities come to companies when other companies don't have cash flow.
Yeah. By the way, to any of my non-Canadian guests or investors that, follow the show, I know you all do a lot of work too. Okay. I'm just saying, they make it pretty clear that they read everything. So, okay. All right, here we go. All right. I'm going to get to my favorite question to ask everybody on here. Harold, what investing experience would you say, had the biggest impact on your career or changed your career the most?
So when I first started in the business, it was 1993, freshly back from Nova Scotia. There was a huge diamond market, a diamond exploration market raging in Canada. It had always been a bit of a joke, Canadian diamonds, were sort of a call signal for a scam, but they actually did find economic diamonds, and the staking rush and the money coming into the market was spectacular. So I showed up, and there's companies being listed for 25 cents or 50 cents and ripping to, a couple of bucks, $5 on millions and millions of shares. And I think they staked an area that might have been, 150% the size of Great Britain. I mean, it was just insane. And, having come from a situation where I couldn't have rent and beer money at the same time, I was intrigued by that. At the end of it, there was a group of companies. It was called the DHK Syndicate. It was 3 companies, and they had discovered diamondiferous kimberlite. One stock was trading at, I think it was $16. One was $12, and one was $9, something like that. And they went and did a bulk sample, and it came back uneconomic. And what's interesting, the stocks, they didn't trade down. Like, there was no oh, those are lousy results, I'll sell it. They just opened down at $1.20, 80 cents, and 50 cents. And I remember being completely floored by the wealth destruction, the wealth creation on one side, but seeing it all come unraveled on the other side. I mean, it was a very profound experience. And after that, you couldn't finance a diamond company to save your life. There was another company in the mix called Aber Diamonds. They'd also made a discovery. They had raised a bunch of money and gotten some debt financing, and they were putting their project into production. It got so bad, the stock got down to 35 or 50 cents. I forget what it was. And they were going into production next year, and their startup cash flow per share was going to be 35 or 50 cents a share. So it got so bad, so hated, that it basically traded for, one time next year's cash flow. And from there, the stock went to 35 or $40 over the next couple of years as they built it up and grew and everything else. So that truly got me hooked. I could never, ever do anything that didn't have this kind of volatility, excitement, and cash flow rules the roost when you need it most.
So did you own the one? Did you buy it at that 35 and watch the run?
I did not. We had a position that went from 20 cents to a couple of bucks, and Aber actually had made a bid for the company, but then it fell apart. So we did all right. But I mean, the story could have been a much happier one. I'm sad to say it wasn't that happy.
I see. Gotcha. Okay. So, hey, look, that's
the business.
Yeah, that'll definitely get you hooked. It's just, I mean, for some folks that might scare you off, but at the same time, if if you go through it, you realize, okay, I think I'm okay, and you're able to come out the other side. I mean, how can you not be, right?
Yeah, well, I think when you're starting out, the key to success sometimes is survival.
Right, 100%, 100%. So okay, so we're rounding the bend here. My final question for you today. What advice would you have for those looking at Canadian microcaps for the first time?
So if you haven't invested in microcaps or Canadian microcaps, my advice would be to start small, and sort of allocate an amount of capital that you're comfortable with risking. You're comfortable. It shouldn't be the money you need to pay your rent, or your basic dietary and hygienic needs should already be covered. Look at a diversified portfolio. You need to have more than one opportunity. Think really hard about your buy criteria and write them down, and then maybe think twice as hard or 3 times as hard about your sell criteria, and then write that down. And when you're reviewing your positions on a go-forward basis, you have to have the criteria there and say, has the company, made any of these criteria? And if I'm not selling it and I should be, why am I not? And part of that is, getting comfortable with the volatility, and not so much the upside volatility. It's the downside volatility that causes people to freak out and or make bad mistakes. If you think a company is a sure thing and you buy it at $1, and 4 weeks later it's trading at 40 cents, are you angry, despondent, or are you so excited because now I can buy 3 times as much for 40% the cost? Quite often, people have the opposite reaction. They think, oh, I'm an idiot, I made a mistake. Go back, review your criteria. Were your criteria sound? Was it valid? Is it still valid? Should you average down? These are sort of the things I think you should think about. And this is part of how we try to help our clients is, not just finding ideas, but navigating the emotional train of being invested. We all think we're purely intellectual. You look at a long-term chart, I could buy that at $1 and I could hold it to 100. Well, you probably can't. Or I could buy it at $1, get crushed to 40 cents. I can do that, and then it runs to wherever. But it's harder than it looks. So kind of get a feel for your own emotional capacity to deal with highly speculative, volatile stocks.
Well, that's incredible advice right there to end our chat today. So where can our audience go and find more information to learn more about the Leishman methodology and get in touch with you?
So our website is leishmancatling.com. So leishmancatling.com. You can email us at lcgroup@cgf.com. You can call me 604-643-7623. We love talking with investors that are excited about microcaps. There's always this sense of community. People, a lot of investors that we deal with that are sort of high net worth guys, they like to make money, but they also like the intellectual exercise of, hey, let's learn about something new. Let's learn about a business. There's a bit of a community around it. All in all, it's a great experience if you're emotionally able to take it. So that's who we are. That's where we are. Looking forward to your event next week. Super excited with that. So thank you so much for having me. I really appreciate it.
Dude, it's great having you on. Thank you again for not only joining me here today, but also for moderating the panel that we got going on next week. So with that, Harold, thank you. Have a great weekend. And I look forward to chatting again soon.
Thanks, Robert. And happy Thanksgiving.
Thank you, you too. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and make profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.